Hi, good morning, everyone, and welcome to the quarterly market update. A lot to talk about today, a lot going on in the world in the last few weeks. So, my pleasure to welcome Dr. Steve Garf to our video today. How are you, Steve?
Yeah, I'm very well. Thank you, Nigel.
Just after the Easter break, and a lot of people had a few days off, but probably also had a lot of time to read newspapers and watch the news, and not a lot of great, I suppose, news going on in the Middle East. So what's going on, and I suppose the impact on inflation, and then we'll get into the markets, what's been going on.
Yeah, thanks, Nigel. It is interesting that normally when markets are volatile, investors don't really feel that unless you're a market watcher. But this time, I think everyone can feel the effects of the Middle East conflict because it's right there on the petrol bowser. And so that is the biggest impact that the Middle East has had at the moment. It's the price of energy. And when you look at the chart in front of us, you can see that when that conflict intensified at the end of February, crude oil has spiked up by near 80% just in about a week. But here's the thing, Nigel, oil or energy prices spiking like that, it not only affects the price of petrol, it's actually got more generally to do with inflation. And when you look at the next chart I've got up showing the 10-year government bond yields in Australia and the US. Now, bond yields are a little bit esoteric and not much of interest to most people, but they are a pretty good signal of what's going on or what could potentially happen in the future. And you can see here how both the yields in Australia and the US have spiked up. And that's a reflection that the bond market is expecting greater inflation. Now, you can already see in Australia, it actually spiked up at the end of the last quarter. And that's because inflation came in sort of hotter than the RBA expected. So the interest rate rises we saw in February and March this year were kind of already expected by the market. What's changed is those yields have spiked again because of the conflict in the Middle East. So we can probably expect another interest rate rise coming up at their May meeting.
Yeah, absolutely, Steve. I think that's obviously on people's minds, and I suppose the trade-off now between how long will this last, and no one knows exactly, but there's obviously going to be a big impact that comes through food prices, and talking to folks who have been travelling to regional New South Wales would see that it is impacting the farmers. It's impacting every sort of part of life, and that's no doubt going to come through and start to increase prices elsewhere. So the Reserve Bank's going to have a tricky couple of months. For our investors, looking at their portfolios, we've had a pretty good time over the last couple of years, really. But of course, now they're looking at some falls in the values in the last couple of weeks. What's happening in markets, and maybe you want to start in the Australian market, and I suppose something about the volatility as well. Yeah.
In the chart we've got here, I've got two lines. The first wobbly line, the top one is the ASX 200, the Australian stock market. And the line under that, the purple line, is the ASX 200 volatility index. That's often called the fear index, Nigel, because as that rises, it means markets are sort of bouncing up and down. In other words, there's a fair bit of uncertainty going on. And you can certainly see that volatility has increased since, again, that Middle East conflict escalated. I suppose we should point out that when you look at the start of that chart, which is 1st of April last year, you see a much higher volatility. That was when tariffs were introduced and then put on pause. So while volatility is up at the moment, it's actually not as high as it was back a year ago. But you can certainly see the effect on the market. You can see the Australian market this quarter is down. It's down by minus 1.6%. And while negative numbers are never good, minus 1.6% is sort of not that bad. I think more importantly, Nigel, when we look at the 12 months number from March to March, it's up 11.7%. That's pretty good for an annual return. In fact, that's higher than the long-term average.
Look, I think that's what we're seeing in most of the conversations and meetings we're having, is that it's actually not as bad as people fear. I think they don't want to log in almost. And they go, hang on, that's not as bad as I thought. And we'll get to the reasons for that. I suppose the US and the global markets are still a large part of the world, and it really does make an impact. So what are we seeing over there? Because it is interesting that Australia hasn't, when you look at it from an annual point of view, the market hasn't fallen as much as perhaps people have thought. So is it a different story overseas?
In a way, it is. When you look at the next chart here, we're showing both the developed markets, which is chiefly made up of the US, So that's the second column there, but also Europe and Japan are big parts of the developed markets. We've got them there, and the emerging markets. And I guess the takeaway here is it's a bit of an own goal by the bombing of Iran, because you can see the US market has been the hardest hit, down 7% for the quarter. And because that's a big part of the developed markets are down around 6%. But you can see that's not even. In other words, Europe and Japan are not down that much. And when we go to the far right of that chart, you see the emerging markets only down by minus 2.8% for the quarter. Again, negatives are never good, but that's not that bad. And you look at the full year return and you go, you know what, that's pretty good. So once again, for an investor who's diversified in both Australian, international shares, it's actually not that bad an outcome over the 12 months, despite the current volatility and the fact that markets are a bit down.
Yeah, interesting times, of course, and conscious of people. There's a lot of news around. We're going to run out of fuel and all those sort of things, and so what impact does that have? So far, markets have responded as you'd expect. Volatility is part of the natural course of you can't get long-term returns. Unfortunately, we've had a bit of volatility, but we're aware there's a bit of uncertainty. We know that our investment philosophy works through these times as it has in the decades before us. And we are here to speak to, but the philosophy stays the same. We don't suddenly make a huge change and say, look, we're getting out and we're going to sit on the sidelines. We stay diversified. It's worked for a long period. No one knows exactly what's around the corner. But of course, we use that diversification as our friend and our investment philosophy as our friend to get us through these little wobbly times. And as you said, the annual returns and long-term returns are still looking very healthy. March not so good. We'll see what happens in April. Fantastic, Steve. Well, thanks again for your time. Always invaluable. And of course, anyone listening who wants to reach out, please contact me or one of the advisors in the team.